He is the activist known for warning a hurricane was coming for the office space market. But now that storm may be about to blow out to sea thanks to Fed rate cuts. Activist investor Jonathan Litt joins us now. He's founder and CIO of Land and Buildings. Jonathan, great to have you back.
Thank you for having me.
So the Fed's starting to cut. All the problems are solved in the space?
So just on the home builders, if I can take a step. So it's going to be interesting as rates come down because the problem has been existing home sales have been very low. And so home builders have been winning. If existing home sales start picking up, that could be a challenge for the traditional home builders that have very elevated levels of new construction. So I don't know. I mean, I've read a little bit about the release, so I don't know it entirely, but that's something we're worried about.
But in terms of how you think about that, I mean, rates would have to come down significantly enough for existing homeowners to put their homes on the market. Now, I mean, it's not just going to go from 6+ to 5+, and they're going to be like, okay, we're off, list me.
I mean, the dot plot is, 5.5 to 3, and that's what it's been. We just started. I think, and I'll talk about this commercial real estate, it's game on, right? The buyers, there's a palpable sense and shift the past few weeks from private real estate folks and public companies. They're back. They got great financing. They're accelerating their transaction volumes. I think homeowners that have been waiting and staying longer than they wanted, they might be selling as well. And that might be coming on the market, and they'll deal with the mortgage, and they've gotten accustomed to it. So we're cautious on the home builders. Not that you're asking about that, but...
No, but I mean, it just sounds like this could be a short in the making here for you.
We're monitoring it.
All right, for commercial real estate now, where do you see the best improvement?
Right, so game on, right? Acquisitions are going to ramp, and they're going to ramp aggressively. Financing costs, we're seeing companies financing in the 4s again. This is the lowest we've seen in a couple of years. And the big winner is going to be the brokers. So CBRE is a real estate broker, commercial properties, and we think they're going to beat nicely on earnings next year because the street is still assuming subdued transaction volumes next year. So I think CBRE is really well positioned as a broker, sort of getting in the middle of it. I think other companies, Equinix, which is a data center REIT, demand is growing exponentially. We don't see that slowing. It's a secular trend. Company's growing 10%, still off of its highs. We think they're really well positioned. Money, we were at the B of A conference about a week and a half ago. They said the REIT ETF has 2 times the demand of any other ETF in the B of A system. So people are looking at this and they're saying it's time to own the ETF, the REITs.
So it's nice to hear money's coming in, but it sounds to me like that sovereign funds aren't right now ready to put a lot of money in. Maybe that's not true. The big money center banks aren't really don't seem to want to be upping their commercial real estate exposure right now. Where's the money coming from?
So 2 different questions there. So sovereign wealth funds different than the banks. The banks are probably slow to start the lending again. The private lenders and really the unsecured debt market, the public companies have a huge advantage because they can finance easily in the public markets at the lowest rates. So they're going to have access to public and private, public equity and public debt. So they're going to be the first ones. But the Blackstones and Starwoods of the world, they're going to be having access to the debt. They already have the equity capital that's been committed. They've been unable to put it out. So they're going to be coming in, as well as many other real estate private equity firms that have the commitments. And many of those commitments are from the sovereign wealth funds and pension funds. And they're waiting for that money to be called and deployed.
In terms of the cycle of this commercial real estate trade, I say this somewhat tongue-in-cheek. I mean, Jerome Powell and the Fed are certainly the most important guys in any room, in almost any markets. But how about the HR managers in the C-suite at Amazon and Google and the guys that are calling people back to work? I mean, the trend here to getting back to office space is real, and it's very different than it was even a year and a half ago. Is that at all playing into the demand side of the trade where you guys see it?
So, there's a lot of rhetoric around who's coming back to the office, and the executives want everybody back. And it's hard to know from talking to folks how many people are actually back. As you know, we use cell phone data, and we track how many phones are in the building. That's a reasonably good sign of how many people. It's not really moving nationwide, and it's not moving in New York. And so we're not seeing it yet. The private real estate executives I met with a few weeks ago said the worst is yet to come for New York. They said there's more people back in the office. There's a little bit more activity on leasing. But they said the capital markets are a disaster. You can't get loans. assets aren't clearing. There hasn't been price discovery, and there's going to be a lot more pain in the New York market, which, I agree. It feels like more people are back in the office, but the problem is really the financing side, and there's not enough. When you have a 20% vacancy rate, it takes a long time to get pricing power.
Just quickly on the cell phone data, you're using it in the context the last time you're on with a short on Alexandria. So where are you on that position now?
Alexandria has underperformed REITs by about 20% since we first came on to talk about it. We're monitoring the data. It's not changing. And what's happened since we started talking about it is the street is seeing the weakness in demand for lab space. And we've had 3 or 4 downgrades, which, as you know, most of the street sits and holds and buys. So the downgrades are significant. Earnings estimates are coming down. And I think this is going to be a long play. This won't end and reverse course quickly. Too much construction, very weak demand. Major markets like Boston and San Francisco are going to be challenging for companies that own lab space.
Okay.